Welcome to our YouTube live, and I'll be with you for an hour. So you can ask any questions you like, as long as it's to do with finance, although strangely people do ask about music as well. So usually what we do is the people who get to the front of the queue are the people who ask us super chat, because then obviously that helps feed us, helps feed Teddy treats. Teddy likes treats. And the other way to get to the front of the queue is to support us on YouTube. So there's a very low membership cost. And if you do that, then we'll answer your question first. So I saw we've got a super chat already. Thank you for that. Thanks very much. Francisco Anonymous. Thank you for that. We appreciate it. And so yeah, any question you like, I'll be with you for an hour. I think, just to kick things off, obviously everyone's talking about inflation at the moment. So we've just had the inflation data for the US. So if we have a look at that, then you can see that this is the actual release that was put out on November the 10th. And if you look at the components, the big shocker, I think, was that fuel oil is up by 59% year on year. And gasoline is still up 49.5. I mean, I thought that it was kind of tailing off, but in fact, in October, the month-on-month increase was for energy commodities was 6.2%, for gasoline 6.1%. So we're still getting this spike in gasoline and energy. However, if you look at used cars and trucks, that really has peaked. Now it's only down to 26.4 year on year. Whereas previously it was above 40% year-on-year growth in used cars and truck prices. So there are certain things which are going up which are more sticky. For example, all of this stuff is pretty much, due to the shock of the massive economic shock of the pandemic. What's more worrying is that things like rent prices are going up. The cost of rent is going up, and that might be more sticky. So that's obviously what the Fed is worried about. It's the components which aren't due to the shock and which will live long after the shock has gone. And the worry is that we'll get a price wage spiral where wages chase prices and prices chase wages. But certainly at the moment, it's not looking like that's the case. More of the alarmist camp in YouTube have been saying that this is the beginning of the end, but I still think that a lot of these components will be short-lived, and by short-lived I'm talking about 6 months max. But obviously nobody can predict inflation, and I can't either, so we'll just have to wait to see what happens. This is the actual data. If you strip out the volatile components, which are energy and food, you get the blue line, which is also up, to decade highs of 4.5%. So core inflation up 4.6%, and the headline inflation, which does include food and energy, is up 6.2%. So markets were a little bit shocked by that. So if we have a look at the 1 month data, then you can see that the Nasdaq took a little bit of a tumble as a result of this. So markets didn't really take it well, and it was a bit of a shock. But I still think it's not catastrophic in terms of we're not up to kind of like 15%, which is where we were if you go back further in time to the kind of Volcker period. This is inflation. Right, so 1970s, 1980s, and I've done a whole video about why I don't think we're going back to that regime, because many reasons. The video I did this week for Patreon members, was about how to get started on our platform. So if you join as a Patreon member, a lot of people were kind of in a kind of state of shock because there's so much content. So I did a kind of starter video, which kind of eases people into the membership, which people seem to like, because what we're trying to do is to build a very broad platform so that even if you've got very little experience of investing, you can join us, and we all kind of lift each other up to a higher level of understanding and a better level of investment. That's the goal. So this is just the kind of primer to get you up to the kind of foothills as you climb the cliff of knowledge, and then we all help each other up once we get to a certain level. And I do encourage people to help each other, because often if you teach someone else something, it really consolidates that knowledge for you. So just restructuring the knowledge to explain it in itself teaches you something. So helping other people really helps, I've found. Certainly that's what I've found in my life. The other content, for this Saturday, we've done a video about flows. So, where's the money flowing? Which funds are hot? Which funds are not? And I think that's really interesting. There were a few surprises there for me. So anyway, that's coming out on Saturday, but our Patreon members will get a preview of that. In fact, they've already got that, so they can watch that before everybody else. So that is kind of interesting. I was surprised. Anyway, so let's get back to the questions, and I'll ask my...
There's one for you already.
Yes, Laura says there's already a question from a member.
Not a member, super chat.
But not a member. Okay. So let me just switch my settings here. Back to me talking. Right. And it was a super chat. And the question was, I was trying to find the best multi-factor funds ETFs in the UK, but all funds have different indexes that they track. How can we find which is the best? So if we look for just ETF, so good source of, let me just share my screen again so you can see this. So let's have a look on just ETF and just see if there are any exchange traded funds which are multi-asset. And I think what you mean by multi-asset, and clarify this if it's not true, Francisco, just tell us whether you meant combinations of factors, for example, small cap value or momentum and value. Is that what you meant? I think it's what you meant. But if we have a look at factors, so it probably comes under multi-asset strategy ETFs, perhaps, or multi-factor, I think is probably what you meant. So the number of these, fairly limited, only 5 ETFs are available. So there's an MSCI World Multi-Factor ETF. There's a Goldman Sachs Equity Factor Index ETF. Global Equity Multi-Factor. There's one from Franklin Liberty Q. Global Equity Socially Responsible Investing ETF. And Multi-Smart Allocation Scientific Beta ETF. That sounds fancy. And the fees for these are all fairly high except for the JP Morgan one. So each of them will have a different combination of factors. And it's always worth looking. If it's a passive index, then you can always look to see which index it's tracking. And the MSCI fact sheets are really good. So if we Google MSCI World Multi-Factor, this PDF, will tell us, oh no, there isn't a PDF for this one. So it's just like a page on the website. What am I accepting here? Okay, so this tells us what it is. So it's focusing on drivers of developed market equity performance. So it looks for value combined with quality, combined with momentum, and it's got a tilt towards small caps. So it's a combination of small cap, momentum, quality, and value. So that's pretty broad. So let's have a look at the performance, because that's kind of interesting, obviously. And if we look at the chart, you can see that if you compare it with, actually this is just compare it with the index. I wonder if we can get the actual fact sheet for this. Yeah, so it's often interesting if you can get the fact sheet. It tells you a lot of the interesting stuff. For example, it'll tell you the holdings, we can also look at the holdings here and look at the composition. So we can see that IT is about 27% of the index. That's fairly standard for an MSCI global fund. It does have a very high allocation to the US because that combination of factors favors the US. So that's about an 11% overweight. So just MSCI developed would be about 60% US. So this is about 11% overweight US. Japan's roughly market cap weighted. Canada's a bit more than usual. UK a bit less. And then the sector composition, a lot of industrials, information technology, a lot of consumer discretionary, which is interesting. So companies like Amazon. So that's kind of interesting fund. So that's what I'd do. You know, I'd look at the fee. I'd look at what's in it. Look at the sector composition. You know, is it overweight here, underweight there? Are you happy with that? And then I'd look at the country allocation. You know, does it give you a large US overweight, underweight? Because that in itself is a tilt. And then ideally, you'd actually pick up the index which it tracks, because that often is really good from MSCI, but I couldn't find the index itself. See if it talks about the actual name of the index here. Yeah, here we go. The benchmark index is this one. So if we search for that, then here it is. So this is what MSCI, so that all it's doing is copying the weights given to it by MSCI. And this is the performance versus MSCI World, which is a developed market index, because this is developed market equity. And it has performed better, although the outperformance isn't huge. So recently we've had pretty much of a junk rally where quality didn't outperform. So it's not surprising that it hasn't performed particularly well since the pandemic. It hasn't outperformed much, but it certainly hasn't underperformed. So yeah, I'm kind of interested by that fund and that tilt. I wasn't actually aware that this thing existed, but if you look at the country weights, you can see the huge US allocation here, which some people might not like. But of course, it does have a tilt to value, so it won't be buying the most expensive US stocks. So for example, we'd expect to see Apple here, but Apple would usually be about 4%, whereas here it's only 2%. So the parent index here, you can see the weights are quite different. Half of the Apple weighting and a huge amount of Cisco compared to the parent index. So that's roughly about 6-fold, 7-fold overweight for Cisco systems, for example, because it must score very well on that combination of factors. So this index has got 333 stocks in it. MSCI World's got 1,500. So you can see that it's a bit more concentrated, and but the highest weight in this index is only 2.5%. That's Cisco, whereas in the parent index, Apple is over 4%. So, you know, that's the thing I'd look at. You know, look at the fact sheet, see if the tilt that it's got is what you want. And you can see the tilt here is very clear. Value, small cap, and it's supposed to be momentum, but it hasn't actually got momentum on there, and quality. And it's got some incidental tilt here as well by the look of it, low volatility and yield. So this fact sheet I find really useful. So yeah, that's what's available in the UK. That's how I, look it up. And there we go. So I hope that answers your question. And we'll go back to the questions. And the question is from a member who's Stephen J. Thank you for supporting us, Stephen. And he says DM, so that's developed market global bond ETFs, are down, while the all country world index, which includes emerging markets, is up. Should I put increments of cash in the bond ETF this month? And to ACWI ETF, which is the global all country world index equity fund, when it's down over a 3-year period, then if a crash happens, put it in ACWI. So effectively what you're saying, Stephen, is when bonds fall and equity's up, should you buy more bonds? So should you sell equity? I guess what you're saying is instead, when you're drip feeding in, you top up the bonds and not top up the equity. And the answer to that question is yes, because if you are trying to keep a kind of fixed equity bond split, that's exactly what you do. But that'll naturally happen if you're always allocating to a certain percentage equity in bonds. So if equity outperforms, let's say you start off 60% equity, 40% bonds, and then equity rallies to 65%, bonds go to 35%, then any money you drip feed in would go into the bonds to top it up to 40, right? So yeah, I mean, if that's what you want, yes. But remember that equity on the long term outperforms bonds. So I did a whole video on portfolio rebalancing. And the interesting thing is that if you don't rebalance, you just let the assets do their thing, what gradually happens over time is that equity comes to dominate the portfolio because equity long term outperforms bonds. That's what we know, right? So if that's the case, then eventually your equity bond portfolio will become an equity portfolio with a bit of bonds over decades of time. And actually it performs better as a result because equity will be a bigger proportion of your portfolio and it'll perform better than bonds. But if you want to keep volatility constant, you don't want big crashes when markets take a tumble, then yeah, you just keep a constant equity bond split to whatever level of volatility you're happy with. Because if you sleep better at night that way, then that's what's right for you. And there is no perfect portfolio for everyone. All of us have got to find our own path in terms of what volatility we're happy with and whether we can live with large fluctuations, because it is scary when your portfolio loses a large amount of value and nobody likes it. But the optimal behavior, remember, is to have 100% equity for your long-term allocation. But yeah, what you're saying, Stephen, is exactly what you do if you're doing that constant equity bond split. Right, so back to the questions. And
Another member.
okay. Oh, there's another member question, Laura says. Hi, Ola Yorokan. Thank you very much for supporting us. We appreciate it. And you say, hi, Ramin. Would you buy the Lifestrategy 80% today as a single fund? Happy to stay invested for the next 25 years. Well, if it was for 25 years, I'd probably go for 100% equity, to be honest, because I kind of think that we know that equity outperforms, and particularly over a 25-year period, it's almost certain that your 100% equity portfolio would outperform 80% equity, 20% bonds. Oh, I can hear some sniffing. Right, there you go, Chief. Yeah, well done. He's a good scavenger. So yeah, I'd probably go for 100% equity, but would I be happy with Lifestrategy 80? Yeah, it's okay. It has a very large UK overweight. Remember that. So the UK has underperformed for the last decade, longer actually, and it's actually becoming a smaller percentage of global markets. It's only 4% at the moment, and it's getting smaller all the time as people pull money out of it and also as it underperforms and the rest of the world just leaves it behind, particularly the US. So that's why I don't like the UK overweight in Lifestrategy funds. That's the only quibble I'd have with it. So if you go for the HSBC strategy funds, for example, those don't have a UK overweight and they're a bit cheaper, I believe, except for the 100% equity one, which is a little bit more expensive. I think it's 0.23%, whereas Vanguard is 0.22% fee per year. So, but would I be happy with Lifestrategy 80 forever? Yeah, it would be pretty good. I wouldn't have any issues with that. And for 25 years, yeah. It's always good to think of your portfolio this way. The core portfolio is, would I be willing to hold this forever and hand it on to my children if I die? That's a really good approach to choosing your core portfolio. And yeah, that would be something which would definitely be eligible for mine. But as I say, if it was a lifetime portfolio and it was for a long period of time, say 25 years, I'd go for 100% equity. I wouldn't go for Lifestrategy 100. I'd go for something which is market cap weighted and global. So a simple market cap weighted cheap fund. Because over a 25-year period, the fees will matter a lot. You get to keep more of the gains if the fee is as low as possible, and the fee, even a few basis points, can make a big difference over a 25-year period. Remember, you're not trying to make the fund management industry rich, you're trying to make you rich and give away as little of the gains as possible. And as buy and hold investors, you really are starving the investment industry of your money, which is a good thing, right? They've got enough money. Okay, next question is from Gary, also a supporter. Thank you, Gary. He says consumer demand in China is slowing. Real estate is also in turmoil, true. And the US infrastructure bill is being wound down, although it was passed, some of it was passed. How confident are you still about the commodity supercycle hypothesis? Thanks. Well, I think China is definitely slowing. I think China's trying to get its house in order. I think President Xi really does believe in this policy, which is that they try and level up their society. There are too many billionaires. The distribution of wealth is very clearly skewing towards the ultra wealthy. And obviously the housing market's got out of control. It's too large a part of GDP. But if you clamp down on it hard, then you risk popping a massive bubble. And obviously nobody wants to do that because we know what happens when you pop credit bubbles. So I think what they're trying to do with the 3 red lines, which are caps on leverage, caps on taking too much risk, balance sheet risk on development companies, property development companies. And for example, Evergrande crossed all of the 3 red lines. And so it was the first to go. But there will be others. But I think China ultimately will grow again. Because remember, what they're trying to do is to shift the focus to more value-add technologies. Things like artificial intelligence, things like AI are going to be very productive in future. Things like silicon chip manufacturing, becoming less dependent on other countries for that. And things like, basically high-tech industries, things like electric cars, batteries for electric cars, and moving away from, yet another social media site where people can chat to each other, or allowing a company to dominate the payment market, which is what Alipay effectively has done. So I think this will take a little bit of time in order for them to get their house in order. But will they return to high growth? Yeah, I think they will. Will they carry on their plan to urbanize China? And will people carry on moving from the countryside to the cities? Yes, I think that's true. So I think the growth will return. Eventually, they're going to become a developed market. They're already not fitting into the EM category at all, really. You can't compare China with other EM countries. It is a very different beast. So I think the whole EM category for China is kind of wrong. It is kind of sui generis. It's its own thing. But is it going to destroy the commodity super cycle, this slowdown in China? I think there'll be a blip. But if you look at iron ore prices, so let's bring up iron ore. Again, let me share my screen so you can see this. So let's have a look for iron ore. I think it's that one. Yeah, here we go. So this is what's happened to iron ore since 2013. So just take a look at that. Right, so that's down how much since the peak? So the peak in August, July or August, it's now down 54%. Now, how long is that going to continue? probably not very long. And at a certain point, it's going to bounce back because China still has to build some buildings, because if urbanization continues, it's going to bring back that demand. And remember, the US infrastructure bill, even though it's scaled down, is still massive. You know, we're talking about trillions spent in the United States in commodity intensive infrastructure building. So I think the commodity supercycle story is still a good one. If I actually look at my portfolio, there is a commodity fund which I've bought, which is the long dated LNG commodity futures fund, and that's still up about 25% since I bought it. So I'm certainly not going to sell it. I still think that story is intact, and I don't think that there's going to be an end to this commodity boom anytime soon. Certainly for the next year or so. So I'm happy to stick with that for now. So no, I think is the answer to your question. I think the commodity supercycle is still going. Right, next question. Oh yes, do like our stream. That certainly helps us. Even if you're watching it in replay, do like us and tell your friends about us and subscribe to our channel if you're not already. Right, so back to the questions. And interesting question from Rob, who says, what's better for the bond allocation of a UK investor's portfolio? A mix of US bond exchange traded funds plus a UK bond, or just a single global bond ETF? Thank you. So personally what I've done is I've gone for a kind of split between US treasuries and UK long dated gilts in my portfolio. Why did I do that? Well, part of it was, I don't want to just be exposed to the UK yield curve in case something like, there may be a yield shock in the UK which isn't felt elsewhere. So let's say inflation spikes in the UK, the Bank of England overreacts, and suddenly we get a big sell-off in UK bonds. Well, if I have 50% in UK bonds and 50% in US bonds, the Fed's reaction function, as they call it, may be different from the Bank of England. So I do get this diversification in bonds as well as in equity. So I think, I'd probably go for a global bond. Effectively, that's what I've gone for by having this kind of mix between US and UK government bonds. So that's what you get. You get the diversification. So that's what I prefer. Because with bonds as well, you probably want some degree of diversification, because for the same reasons that it benefits equity. So that's what I'd probably go for if you want safety. And let's face it, that's why you buy bonds. It's for the safety. And also for the fact that they rally when equity falls. So for a global bond fund, that would happen a bit less. The rise you'd get when equity crashes for a globally diversified bond fund would probably be smaller, but it really depends on the duration of the fund. Long duration funds would rally more when equity falls, and short duration funds rally less, right? They're more like cash. So really those are the considerations. What's the duration of the fund? That tells you the sensitivity to interest rates, and it also tells you whether you'll lose sleep at night because of your bonds. Because I had lots of people talk to me, members in power hours. So a lot of people choose to have a one-to-one with me. You can do that too. But in the power hours I had in January and February, everybody was freaking out about their bonds falling, particularly the long duration ones. But I didn't, because I just knew that it would be volatile, and I was happy to live with that. If anything, you should have bought more of those volatile bonds when they crashed. So just be aware of that duration effect, because that's probably the most important thing. But diversifying makes sense, I think. Kevin says, why would you ever buy a trust when the net asset value is higher than the price, i.e. at a premium? Isn't it like buying the underlying shares at an inflated price? Yeah, I think that's kind of true. Just to show you what Kevin's getting at, let me pull up Scottish Mortgage because it's a nice example. Right, so this is the UK fund, which is kind of like Cathy Wood's ARC fund. Now let's look at the returns since 2020, and you can see they've just gone vertical. So if we add to that graph, I think I can add it here. So draw, no, I don't want that. I don't want that. I'm going to add the net asset value. Additional sector, net asset value. Here we go. So green here will be the net asset value of the fund. What is that? Well, remember that with Scottish Mortgage, it's actually a closed-ended fund. There's a fixed amount of capital in the fund, and if somebody wants to sell, they have to find someone who's willing to buy. So the actual amount of money that flows into the fund or out of the fund is zero net. But the size of the fund varies according to the value of the assets. So if we add up the value of the assets, that's the green line. But if we look at the price you pay for those assets, that's the black line. Notice how currently the black line, which is the price you'd pay, is more than the net asset value. So the question is, would you buy this fund now? And when does this happen? Well, it happens when the returns are high, usually, because then it becomes popular and people are willing to pay a premium to buy the fund. The time when it becomes cheap is when it's underperforming. So if we look back in time, we can probably find a period, although this is a pretty popular fund, when it was actually underperforming. So all of this period here, when equity markets had crashed just after the global financial crisis, you can see it was trading at a big discount to the net asset value. And that was a pretty good buy signal. But then we had this very strong rally, and even so, it was trading at a discount to NAV. But currently, because the returns had been crazily high, it's a premium. So I'd say that's pretty much a sell signal. And that's why this is part of my market shopping list, my market crash shopping list. Because when markets do crash, this thing will crash a lot. You know, we saw that in March last year. We saw it in 2008. This thing crashed a lot. So that's the time to buy it. When there's nobody else who wants to buy risk, when people just don't like equity, they think it's a mug's game, you know, the world's ending, that's the time to buy Scottish Mortgage. And then it'll be trading at a discount. So yeah, you're right. I think it's best to buy these fixed capital investment trusts. It's best to buy them when they're trading at a discount. Good question. Oh, we've got another members question. Let me just switch off that. Back to me. And this is a question from Adrian Cook, who says, so Adrian Cook's a supporter. Thank you, Adrian. He says futures for commodities contracts such as oil are lower in price into next year than now. The commodities headed moderately lower into 2022. So what you're talking about is the shape of the futures curve, and I actually don't have that on any of the price sources which I use. But if I had a Bloomberg terminal, what I could show you was that normally commodities curves are kind of upward sloping, but if they go into backwardation, then the short end of the curve goes higher than the long end because there's a big demand for physical oil. So spot prices, you know, not a futures price, the market today trading for a barrel of oil will be above futures prices. Now, is it a good predictor of future prices? No, not really. if you look at the Bank of England's inflation forecast, built into that is the price of oil, and they did build it out of the futures curve. So it's as good as a guess as any. Backwardation usually means that oil has surged recently because of a demand surge or a supply shock. So yeah, I think it probably will head lower, because we have seen the oil price, obviously. So if we have a look at Brent crude, here we go. So if we look at Brent, let me share my screen again. There we go. So this is the price of Brent crude, and you can see that it's been surging pretty much to $85 over the last month or so. So currently it's at around what, $83 a barrel. So that's a pretty big run up. But the thing to remember is that this is an industry in its dying years, but there's still big demand for oil, even though oil exploration has really been cut down a lot because of lack of capital. So, you know, an oil company just can't justify spending a huge amount on exploration because they're so careful about how they spend their capital at the moment. And they have been starved of capital because the shift is clearly towards ESG, electric cars, and the energy transition. So it's just not a sexy sector, energy, anymore, or at least the fossil fuel part of it. So I think, you know, underinvestment in exploration, we still have demand, so we have a limited supply, which doesn't have much new reserves on tap. So I think that's actually a case for a further push up in prices. So, you know, I think that's the kind of countervailing argument, which is the undersupply due to lack of investment, remaining demand because countries still haven't got alternative forms of energy. So I think it's likely to actually have pretty good support over the next couple of years. Eventually, of course, it's going to decline, but certainly not for the next few years. So I think personally, I think there are reasons why it should stay elevated, and my guess would be that it probably will stay elevated for a while. But remember that inflation number. Inflation's calculated based on year-on-year price changes. So of course, if we compare this month with November last year, so if we just look at 1 year's of data, so 1 year, obviously the year-on-year increase currently is huge. But if we look 1 year from now, probably it won't be so big. So its effect on inflation, even if it stays high, will gradually decrease as this window slides, the 1 year window slides forward in time, and we don't have such big rises. So yeah, I think the inflation effect will be limited in a year's time. So inflation will come down, but I suspect the price will remain high. That's just my guess. You know, oil is notoriously difficult to forecast. And certainly I'm no oil strategist, so I'm not the right person to ask. But, you know, I do speak to people who've worked very closely with the oil industry as senior executives in the industry. And what they tell me is that it's likely to stay elevated for some time, you know, a couple of years at least. That's the beauty of this job. I get to speak to really smart people who are incredibly well informed. It's one of the privileges of the power hours. You know, so if you do want to arrange a power hour and you know about the oil industry, even better. If you don't, hey, that's still fine. I get a lot out of it, and so do the people I speak to. Anyway, Gary. Gary says, so thank you for supporting us, Gary. The HSBC strat funds imply that they have a max percentage cutoff on return. Is that so? Oh, I wasn't aware of that. So they're capped. Interesting. I didn't see that on the term sheets. Let's have a very quick look. HSBC strategy funds. So these are the funds I was talking about. So maybe it's good to show you these, just as an alternative to Life Strategy. Here we go. Percentage cap on. They may have a percentage cap on allocation. You know, sometimes they say, well, we won't put more than X% into an individual stock. So let's have a look at the adventurous one, for example. And I can't see anything about a cap on return. Let's have a look at the fact sheet. And I'll go back to your question. Let me just look at your question again. Max percentage cutoff on return. I don't think so. At least I can't see it on the fact sheet. Probably be in the small print if they do have some kind of cap. Nope, I can't see it. But I'd be amazed if that was true. I mean, some funds do that. You know, they sell the upside and they boost the yield. So, for example, QYLD, that's exactly how it works. You know, that thing has sold the upside in order to generate income. So that's why it pays such a huge dividend yield of 12%. So, you know, QYLD will have a cap on the upside because it sold it using options. It sold the upside options in order to increase the yield, and that caps the gain. But yeah, I don't think that's the case for those HSBC funds. Right, back to another question from a different Gary, who says, who's also supported, thank you. The consensus is that treasury yields are on their way up and trade-weighted dollar index has bottomed. Does it make a particularly bear case for gold? Well, if the dollar does strengthen, obviously it's bad for gold because it's denominated in dollars. And if treasury yields are back up, that tends to strengthen the dollar. And it's also bad for gold. So that would be a bad bear case for gold. Although it's true that if you look at the real yield versus the price of gold, that relationship has kind of gone wrong over the last 6 months or so. So real yields have gone up. Real yields have gone down, but the price of gold hasn't gone up as a result. So we have a kind of linear model of the price of gold, which is available to PensionCraft members, and that's currently forecasting or saying that the fair value of gold is much higher than where it is now, and that's based on the real yield. So yeah, I think there's a bit of a mismatch there. Gold simply isn't popular at the moment. You know, that seems to be the case. But anyway, if that does correct, then I would expect to see a bit of upside for gold if that relationship goes back into synchronization with where it's been in the past. So that would be supportive of the price of gold. But if what you say is true, if yields are going up and the dollar strengthens, that's a terrible backdrop for gold. But of course, that's what we're expecting. We are expecting better growth in the US. That usually pushes up yields. And we've also got inflation, which is going to push up yields. And that's bad for gold. So there we go. Yeah, not a very bullish situation. But if there is an equity market crash, of course, you know, that's generally good for gold. It's a good equity hedge when markets crash. Right. So that's all of the member questions. We've got 15 minutes to go. Gosh, it's gone quickly today. So remember, do like our stream. It helps us a lot. And if you want to become a member, go to Patreon patreon.com/pensioncraft, and you can join our membership. And then, we have much more intimate calls with our members because there are less of you, and we usually get through all of your questions individually on one of those half-hour sessions that we have every 2 weeks. And of course we have Slack, which allows you to ask questions of each other. Next question. What is the target percentage for bonds in your portfolio once you've completed all your equity purchases? This is from A. James. Well, my goal is 80% equity. That'll be my long-term holding. I'm drip feeding into that over a 2-year period. This Friday will be the 6th of the 24 installments into equity. So I'm building up to 20% bonds, 80% equity. And of course, if there's an equity market crash, what will I do? I'll sell my bonds and I'll buy equity. And I'll accelerate the purchase of equity. In fact, I might go all in if it's a very severe drop. All in to 80% equity. So that's my goal. That's where I'm headed. I mean, if I was really brave, I'd go for 100% equity, but I'm not. Okay, so I'm probably going for 80%. Next question is actually from A. Smith. Okay, he's got some nice smiley faces. What economic and political factors, other than central banks' rate decisions, may affect sterling against dollar or euro in the coming months? What's your view, if any, for GBP, for sterling? Positive or negative? Well, it's funny because, most of my portfolio is in foreign assets. So if sterling weakens, it's great for me, because that means that those foreign assets, when they're converted back into sterling, are worth more. So a weaker sterling is what all people who hold, say, a global equity fund want, because that global equity fund will be mostly in other markets because the UK is only 4% of the allocation. So for me, a weaker value of sterling would be a good thing. What would be the drivers? Well, clearly growth is a very important one. So if growth is poor in the UK, which it is, so compared to other G7 countries, we've underperformed. Exports have been very weak after Brexit. It's pretty shocking how much they've fallen, particularly to the EU, which is our biggest trade partner. So I think the exports are weak. Growth has been poor. And, those two factors will probably reduce yields here compared to the US, for example. And also the flow of capital from foreign countries, from other currencies, has also been low. So, investment has been poor as well by companies. So that combination generally makes the currency weaker. And so, I expect further currency weakness unless the UK manages to engineer better growth. So I think growth is the big driver. And it's difficult to see how that's going to happen. I can't see any policies which are really going to boost productivity in the UK. I mean, the usual ones are education, putting more money into education so that you kind of raise the value add that our industries have, or perhaps building infrastructure. So it was nice to see that they're going to build more internet, faster internet for the UK, make it more rural, so there's better internet connections in rural areas. All of that's good. I like that. That will have a positive effect. But other than that, productivity just hasn't gone anywhere for the last 13 years. People in the UK are paid pretty much to what they were 13 years ago. So effectively, we're getting poorer or just not getting richer in terms of pay. And it's very difficult to break that cycle. And I'm not convinced that the politicians we've got now are trying to do the right things. But as I say, some of the policies are good. Infrastructure, education, those are the standard ways that people say you can improve growth. But those are the things which I think will drive it. And politicians may not be up to the job. It certainly doesn't seem as if they are. There you are. I said something political. There we are. Chalky Scriber, great name. Hi Ramin, these are in large caps as well. Hi Ramin, is it best to sell investments to pay account fees, or is paying cash the better option? Okay. Yeah, well, I'd say that usually I'd use cash because I don't want to sell my investments because you may crystallize a loss. But on the other hand, if you do have lots of cash in your account, then it's a drag on return. But the amount you need in cash in order to pay the fees is fairly small anyway. So it's kind of negligible, the effect. So, just for the sake of convenience, I think it's useful to have a bit of cash in your account so that, the fees come out of that, probably. I don't feel strongly about it either way, I don't think. Whichever's more convenient for you, I think, Chalky. Scott Sandiford says, Hi Ramin, great channel. Thank you, Scott. You said previously you would consider buying Scottish mortgage if there was a correction. At what price level would you start to consider buying it? Well, we already saw that the net asset value is important. So if the net asset value was well below the current price, so if it was trading at a discount, the price was at a discount to net asset value, if it was trading at a discount to net asset value, then I'd consider it. And usually that's after an equity market crash. Remember, Scottish mortgage is leveraged. They borrow money to invest money. So what you actually get is a multiple of what markets are doing, and particularly a multiple of its portfolio in real terms, if it wasn't leveraged. So that means that if there is an equity market correction, Scottish mortgage usually takes a really big hit because of the leverage. So that would be a good time to buy. Is there a particular level I'd buy at? No. But the discount's one thing. The other thing I'd look at would be US valuations, because those are easily available. The US is a good barometer of risk appetite. It's the biggest market in the world. So, I'd look at US forward PE, forward price to earnings ratio. If that's at its 5-year average or below, or the 10-year average or below, then that's cheap. Yeah, that's the point at which I'd really consider buying Scottish mortgage, and a fairly chunky position in it too, when nobody else would ever consider buying it, except for the people that watch our channel, or other contrarian investors. Okay, so Arthur Schuch, I can't pronounce that, sorry Arthur. Hey Ramin, how to implement a life strategy fund using global ETFs? Would it be just VT and BND? I actually did a video about that, Arthur. How to make your own Vanguard Life Strategy Fund. I think that was the title. But if you want to look at that, I actually showed how to replicate Life Strategy with, I think it took 3 or 4 funds, 5 funds, and you can very, very closely match the returns of Life Strategy, any of the 5 funds, with just 4 or 5 funds. And you don't have to use Vanguard funds either. You can actually do it even more cheaply with iShares funds, which I thought was quite amusing. But Vanguard probably didn't think was amusing. So you can replicate Life Strategy using those weights pretty closely for a lower fee. So what's not to like? I mean, you have to rebalance, which is a pain, and the transaction cost might increase the actual fee from your point of view. But if you're on a platform with free trading, and most of us are nowadays, then you only need to rebalance every 6 months or so anyway, at most. So yeah, you can watch that video, Arthur. Next question in the next 5 minutes. Brandy Alexander, good name. That's like the what's the name of the author? Cocktail, yes, name of the cocktail. But also there was it's part of a song, isn't it? By anyway. Hi Ramin, I love your videos. Given the inflation narrative, I'm thinking of putting some of my ISA into Spider MSCI Consumer Staples ETF Oh, and you've given the ISIN code. Cool. Do you think that's wise? Well, consumer staples, consumer discretionary is what you do, isn't it?
Oh yeah, true.
Yeah, Laura was just getting excited. She's forgotten which fund she's bought. All right, dear, more gin. Yeah. Okay. Sorry, we're both getting on a bit. I'll get in trouble for that later. So let me just get camera picture in picture. Here's the fund you were talking about. And this is the State Street Global Advisors. Oh, I'll accept all of that. ETF. So, yeah, I mean, it is the ETF you're talking about, I think. So what's the fee? I'm guessing it's low. Fee. Let's have a look at the fact sheet. It'll be in there. I think it's called OCF. So the total expense ratio is 0.3%. The sector composition, I wonder if they've got it. Yes. So it's got 116 stocks in it. So it is fairly concentrated. There aren't that many companies in the index. The biggest position is very chunky. So about 10% of it, 9% of it is in Nestle. Procter & Gamble is about 9 as well. So just these two stocks make up, gosh, about a fifth of the fund. So I'd be a bit worried about the stock concentration. If either of these takes a tumble, then it's going to be an issue. So pretty concentrated. I'd be worried about that. The actual sector breakdown: a lot in beverages, a fifth in beverages, a fifth in food, a fifth in food and staples retailing, a little bit in household products, personal products and tobacco. So, I mean, just look at the weights, the concentration, see if you're happy with that. Clearly, this is a defensive sector because when equity markets tank, the companies that do well in a recession are the ones which, sell stuff that we have to buy, the staples. So this is a kind of defensive sector. The fee is fairly high, I think, for a developed market index. So if you can find something which is cheaper, I'd certainly consider it. But if you can't, yeah, I mean, it's okay. If you are a bit bearish, then, that would make sense. So back to this. And back to your questions. Thanks for sending the ISIN code. That's really useful because that way we can actually find the fund much more easily. Oh, interesting. Daniel Cooper says, how easy is it for a non-UCITS compliant fund to make itself UCITS compliant? So the idea with a UCITS compliance badge, if you like, is that once a regulator in one country, usually the country in which the fund is based, approves that fund, then it can passport that approval to every other country in Europe. So once you've got this UCITS compliant stamp, then you're done. What are the constraints on a UCITS fund? Well, there'll be things like leverage. It limits the amount of leverage you can have. I believe there are limits on concentration, so how much you can put into a single stock. So that could be fairly easily fixed. You just sell the heavy allocations, you'd reduce them. Leverage, you just reduce it. So depends on how egregiously non-UCITS the fund was. If it was massively levered, then it's a bigger issue. But clearly people want to have a fund which is UCITS compliant because it's more easily sold in a wider market. So, there's a very strong incentive to make a fund UCITS compliant. But how easy is it? Well, none of these regulatory things are easy, but of course, fund managers have departments who specialize in getting UCITS compliant, creating UCITS compliance and doing the paperwork, talking to the regulator. So for a fund, it's probably pretty easy to do, unless the whole ethos of the fund is very non-UCITS. A lot of derivatives, a lot of leverage, a lot of concentration, then it would be hard. And then it wouldn't be the same fund, right? So then it wouldn't be, there'd be no point to it. Oh, interesting. Oh, it's 8 o'clock. So it was an interesting question, but I don't have time to answer it. Sorry about that. This was Apothy 6's question about leverage. So why not ask that next time? So anyway, thank you all for joining us. Remember, you can help us by liking this video. Also subscribe to our channel. You can have a one-to-one with me in a PensionCraft Power Hour. Go to our website, pensioncraft.com/power hour, and you can learn how to do that. And yeah, thank you for joining us, and we'll see you in 2 weeks' time. So good night, everyone, and have a great 2 weeks.